Right now, as you are listening to this, something quietly historic is unfolding beneath the surface of global markets. Not loud enough to interrupt daily headlines, not dramatic enough to stop traffic on Wall Street, but powerful enough to reshape the economic balance of the next decade. On December 11th, 2025, silver prices reportedly surged to around $63 per ounce, a level that, in modern trading history, simply does not exist. Not as a temporary spike, not as a technical glitch, but as a sustained move. Analysts estimate this represents a rise of roughly 113% in just 12 months. That alone would normally trigger excitement, disbelief, maybe even euphoria among traders. But this time, something feels different. This does not behave like a speculative rally. It does not look like panic buying. It does not follow the familiar rhythm of fear and greed that has defined commodity markets for decades. This feels deliberate. When I began studying the underlying mechanics behind this surge, a pattern started to emerge. Not a price pattern, a power pattern. One that history has repeated with uncomfortable consistency. And in every historical case I could find, the outcome was the same. The dominant economic power of the era entered a period of decline, not overnight, not dramatically, but structurally, quietly, permanently. Today, I want to walk you through what appears to have happened in late October, why this matters far beyond precious metals, and why the next 3 weeks may prove more important than most people realize. This is not financial advice. This is not a call to buy or sell anything. This is an analysis of history repeating itself in real time, based on publicly available information. In late October of 2025, multiple trade reports indicated that China's Ministry of Commerce announced new export control measures on silver. Starting January 1st, silver exports would reportedly require government approval, not a ban. Not a headline-grabbing embargo, something far more subtle: export quotas, licensing requirements, national security reviews. Bureaucracy, on paper. Leverage, in reality. Silver is not oil. It is not gas. It does not dominate nightly news. But it sits quietly inside almost every system that powers modern civilization. And what this move effectively signaled was that China now holds meaningful control over the flow of that material. The market response was immediate. Reports suggest that Shanghai silver inventories dropped by roughly 40% within 3 weeks. Physical silver premiums inside mainland China reportedly exploded. Some buyers were paying anywhere between $108 and $128 per ounce for physical metal, nearly double the global spot price. That is not speculation. That is desperation pricing. At the same time, Western mints began reporting widespread sellouts. London Metal Exchange inventories reportedly fell to multi-year lows. Institutional players, not retail investors, began demanding physical delivery instead of paper contracts. Orders reportedly reached approximately 350 million ounces, more than what many analysts believe represents the entire annual global surplus. This is where the story stops being about investors and starts being about everyone else. Your smartphone contains roughly half a gram of silver. Electric vehicles use anywhere between 25 and 50 grams per vehicle. Solar panels require approximately 20 grams each. And then there is the infrastructure we rarely talk about: data centers, artificial intelligence systems, server farms powering tools that now shape communication, research, and military planning. Each server reportedly uses specialized silver-coated components for heat management and high-speed connectivity. Some industry forecasts suggest that the artificial intelligence boom alone could consume around 200 million ounces of silver by the year 2030. Defense applications add another layer: missiles, radar systems, guidance computers. Reports indicate that the United States military consumed approximately 15 million ounces of silver in 2024 alone. Now, here is the uncomfortable math. The United States reportedly produces only about 14% of its domestic silver supply. The rest is imported. And while China does not mine the most silver globally, producing roughly 6% of global mine output, it dominates something far more important: refining. China processes raw silver from other countries, converts it into high-purity industrial-grade material, and distributes it across the world. Or at least, it did. Until 3 weeks ago. At this point, many people instinctively dismiss the implications. China would not restrict silver exports, they say. It would hurt their own economy. This is negotiation, posturing, a bluff. History suggests otherwise. When I examined similar moments in the past, the same structure appeared again and again. Different centuries, different empires, different commodities. But the same 4 stages. Stage 1 is dependency. A dominant nation builds its industrial, technological, and military systems around a critical resource. Access is assumed. Supply feels infinite. Risk is ignored. Stage 2 is weaponization. The supplier recognizes leverage. Restrictions begin quietly. Administrative delays, quality inspections, licensing reviews. Scarcity emerges without formal confrontation. Stage 3 is crisis. Prices surge, production slows, alternatives are discussed, but timelines are too compressed. Supply chains fracture faster than infrastructure can adapt. Stage 4 is realignment. Industrial dominance erodes, currency strength weakens, military advantages fade. A new global order takes shape. Every time this pattern completes, the world looks different afterward. One historical example illustrates this with unsettling clarity. In the late 19th century, Britain controlled roughly 60% of global manufacturing. The Royal Navy ruled the seas. London was the financial heart of the world. But Britain depended heavily on German steel. For decades, the arrangement worked. Germany supplied raw materials. Britain built ships, machines, and weapons. Then, in the 1890s, delays began appearing, not openly. That would have risked war. Instead, paperwork slowed shipments. Quality reviews extended timelines. British factories began missing deadlines. Steel prices reportedly tripled by the year 1900. Britain tried to respond. Domestic steel capacity expanded. But infrastructure takes time. Years passed. Costs exploded. When World War I began in 1914, Germany's steel advantage translated directly into military output. Artillery, machine guns, submarines. Britain survived the war, but it never recovered its industrial dominance. By 1945, the United States had replaced it as the global superpower. The entire transition unfolded in less than 50 years. What makes the current moment even more striking is that China learned this lesson firsthand, from the other side. Around the year 1800, China was the largest economy on Earth. Europe wanted silk, porcelain, tea. China demanded payment exclusively in silver. By the 1830s, China had reportedly absorbed roughly half of global silver production. Britain's silver reserves drained eastward. Its economy bled wealth. Britain responded not with diplomacy, but with opium, flooding China with narcotics from India, reversing the silver flow. When China resisted, Britain invaded. The Opium Wars followed. China lost. Ports were forced open. Hong Kong was ceded. A century of humiliation began. China never forgot that lesson. 185 years later, they appear to have positioned themselves on the opposite side of the equation. And that brings us to the present moment. Based on available evidence, we appear to have entered Stage 3, the crisis stage. The United States government reportedly designated silver as a critical mineral in 2025. Global silver deficits are estimated at around 800 million ounces, accumulated over 5 consecutive years of shortages. Production cannot keep pace with demand. 70% of silver is produced as a byproduct of other mining operations. You cannot simply open a silver mine. If copper or zinc demand falls, silver supply falls with it, regardless of price. Solar manufacturers are reporting delays. Electric vehicle production is slowing. Artificial intelligence chip makers are searching for substitutes that do not exist. Silver has the highest electrical conductivity of any element. Its thermal conductivity is unmatched. There is no effective replacement for high-performance systems, not for military hardware, not for artificial intelligence infrastructure. The Pentagon understands this. Defense contractors understand this. Silicon Valley understands this. And China understands that they understand. Industry analysts are forecasting potential shortfalls exceeding 200 million ounces in 2025 alone, roughly 15% of annual demand, simply unavailable. Official bank forecasts suggest prices in the mid-$60 range by late 2026, but privately, some analysts are discussing something far more extreme: $75, $100 per ounce. Not in a decade, within 18 months, and that raises the real question: what happens next? If this trajectory continues, there are only 3 realistic paths forward. None of them are painless, and all of them carry consequences far beyond silver itself. The first option is simple and politically uncomfortable: pay the price. The United States, along with its allies, accepts higher silver costs, absorbs the shock, and allows industries to pass those costs directly to consumers. Smartphones become more expensive. Electric vehicles rise in price. Solar installations cost more. Electricity bills quietly climb, not because of fuel shortages, but because the metals embedded in the infrastructure have become scarcer and more expensive. This option preserves short-term stability but accelerates long-term dependency. It sends a signal that leverage works. The second option is to source silver elsewhere: Mexico, Peru, Canada, Australia. On paper, this sounds reasonable. In reality, these countries are already operating near maximum capacity. Expanding production takes years, not months. And even if additional raw silver ore could be secured, there is another bottleneck: refining. China controls a significant portion of global refining capacity. Raw silver is not useful to modern industry until it is processed to extreme purity levels. Building new refineries requires permits, environmental reviews, construction timelines, and technical expertise. Meanwhile, China holds an estimated $3 trillion in foreign reserves, giving it the ability to outbid competitors for supply long before alternatives come online. The third option is the only structurally sustainable one: build domestic refining capacity, rebuild supply chains. Accept short-term pain to regain long-term autonomy. But history tells us this option arrives late, almost every time. Britain tried to rebuild steel capacity after relying on Germany. It was too slow, too expensive. The timeline did not cooperate. The United States now faces a similar dilemma. Attempting to secure silver independence after decades of reliance on a globalized system optimized for efficiency, not resilience. And here is where the historical echo becomes impossible to ignore. In 1929, markets collapsed not because of a single event, but because leverage had quietly accumulated beneath the surface. In 2008, the same thing happened, wrapped in different instruments. In both cases, the warning signs were visible long before the crisis became undeniable. What we are witnessing now is not a silver story. It is a supply chain stress test, a question being asked in real time. Will the United States respond decisively, or will it delay until the window for easy solutions closes? The next 90 days matter more than most policy cycles. If China enforces these controls in January, if inventories continue to decline, if other nations begin hoarding strategic reserves, that confirms we are locked into Stage 3. And once Stage 3 fully sets in, Stage 4 becomes inevitable. This is not theoretical. The United States has already acknowledged silver as a critical mineral. Global deficits are no longer disputed. Production constraints are structural. 70% of silver emerges as a secondary output. That is not a system designed for rapid scaling. Artificial intelligence infrastructure, the defining industry of this decade, is deeply silver-intensive. Military modernization depends on it. Green energy depends on it. Electric transportation depends on it. This is why silver matters in a way it never has before. And this is why China's move feels less like a trade policy and more like a message. Because if Washington does nothing, silver will not be the end of this story. It will be the beginning. Rare earth elements, tungsten, antimony, cobalt, materials that rarely trend on social media, but quietly determine who builds the future and who rents it. For 2 centuries, China watched Western powers dominate steel, oil, shipping lanes, and global finance. Watched the dollar become the world's reserve currency. Watched industrial rules written elsewhere. Now, piece by piece, the equation appears to be reversing, an estimated 800 million ounces missing. 4 historical stages, a familiar pattern unfolding. The timeline is compressing. The only real question is not whether this is happening, it is whether it will be recognized in time. Because once scarcity becomes policy, and policy becomes precedent, markets adjust faster than governments. Supply chains rewire themselves, power shifts quietly, and history, once again, does not announce itself. It simply moves on.